let's jump into our planning section. All right, I'm going to share my screen. Here we are. It is time for our Financial 15. What is the Financial 15? Financial 15 is our financial strategies, financial planning strategies, part of our discussion. And if you're just joining us on YouTube for the Financial 15, what you just missed was about 45 minutes of, I'm sorry, that's not true, about 35 minutes of great information from our friends at the Ed Slack group about, what did we talk about? We talked about inherited Roth IRAs and some issues surrounding that. We talked about beneficiary designations. Seems like we always talk about beneficiary designations and what happens if you don't do your beneficiary designations, don't keep track of your beneficiary designations, and everything goes to your estate. So really good stuff from the Slack group. We talked about the markets and what happened last week and what some of the issues we're facing. And one thing I didn't say is, how do you overcome these things? How do you overcome the fluctuations and uncertainty and the things that have the experts scratching their heads? What's going on with the market? Well, folks, you overcome it with having your plan drive your investment strategies. As I said, asset allocation, principal protection, and account segmentation seems to be the answer of giving you a good foundation, so you don't have to worry about when things are going kind of crazy. I can comfortably tell my clients who are in retirement, we know exactly where their funds are coming from for the next 3 years, and we don't have to worry about volatility there. And it fans out from there. It's not that simple, but it fans out from there. So you're going to see me looking down here. Let me see if I can get that little guy off. So this week in the financial planning section of our financial planning discussion is more common retirement mistakes. And this is part 4. So in part 1, we talked about expenses. So the true cost of retirement. Many people miss a lot when they're calculating their expenses, and they end up surprised. And unfortunately, most financial planners don't do a good job of shaking the trees and really identifying what those costs are. I see it all the time. People come to me and they say, I've been working with my financial advisor, financial planner for the last 25 years. He says, everything's going to be great. I'm going to have $25 million by the time I'm no longer here. And I say, well, how much are you wanting to spend every year during retirement? They say $7,000 a month. And when we go through the financial planning process, it looks more like $10,000 or $11,000 a month. And if you don't think that could have an impact on your retirement, you're absolutely crazy. So the true cost of retirement is something you have to work on, and you have to review it every single year. Part 2, a couple weeks ago, we talked about the medical costs after retirement and what those medical costs are. And Medicare tells us that the average healthy individual pays about $5,800 to $6,000 per year in out-of-pocket expenses that most people aren't planning on. And if you're not healthy, well, of course, it's going to be more. And that's per individual. So a married couple, you could be looking at $12,000 a year of expenses that you just may not be planning for. And Medicare tells us that inflates at 5% a year. Last week, we talked about IRMA, the dreaded Aunt Irma. That is income-related monthly adjustment amount. And we saw the impact that IRMA can have on your retirement plan. It can be hundreds of dollars every month for both people who are on Medicare, and that can really add up over time. And this week, we're going to talk about taxes, so let's dive into it. And if you're just joining us for the Financial 15 and you haven't already, hit the subscribe, like, and notification button. I would appreciate that. So what causes tax in retirement? First is myths and misconceptions. So what are the big myths and misconceptions? These critical facts that maybe if you knew things beforehand that you would have done things differently during your retirement planning years, maybe 30, 40 years of your working years that you've been saving. But now you have an opportunity to learn it and make some changes. But these myths are, I'm going to be in a lower tax bracket in retirement. Folks, I guess, what is it? It's 2023. So this is my 22nd year in doing this. I've been focusing on tax-efficient planning since 2012. So that gives me 11 years. I've just in that area, I've witnessed few people who come into retirement spending less money than they did during their working years. Typically, they spend more. And you're losing your deductions. You have only your standard deduction. Your kids aren't in your house. You probably don't have a mortgage, and if you do, you're paying a lot of principal. You don't even get that mortgage deduction, or it's not even If you got your standard deduction, you don't benefit from that mortgage deduction at all. Most people, as they're nearing retirement, only have their standard deduction. And if you need to know what I mean by that, you can contact me at questions@attleborowealth.com. That's questions@attleborowealth.com. So myths and misconceptions. The first is I'm going to be in a lower tax bracket. Well, it's just not the case for most people, just as things are today. So with that idea, people are told, well, if you're going to be in a lower tax bracket in retirement, then the best thing to do is save in tax-deferred investments. That is, you don't pay tax now, you pay it later. Well, the problem is later is probably going to be worse. We're in a very, very low tax environment right now. We're under what's called the Tax Cuts and Jobs Act. This is the 2023 tax planning chart. You can download this from our website, attleborowealth.com. That's attleborowealth.com. And I'm going to just throw it up there for a second. That's attleborowealth.com. And you can download this chart as well as other charts, and you can see exactly where tax rates lie today. And what we're dealing with today, these, from 10 to 37%, and these are the income levels. You've seen me go through this about 1 million times. This is all under the Tax Cuts and Jobs Act, and that expires 12/31/2025. And it reverts back to 2017 tax rates plus inflation adjustments. So what does that mean? That was to get Congress to accept these tax cuts or these tax changes. They said that's fine, but there has to be an expiration on that. The expiration is 12/31/2025. It automatically reverts back to the rules, most of the rules of 2017, but certainly the marginal tax brackets. And most importantly, it's not just these percentage rates, but it's these income rates that are going to be greatly adjusted. So I'm circling married, filing jointly, but you got to pay attention to single here. So we're in a very, very low tax environment, and it's likely to be much, much different in the future, and not just because of the scheduled conclusion or sunset of the Tax Cuts and Jobs Act, but because of some other things that we're going to talk about. So what causes tax and retirement myths and misconceptions? You're not ready for it. You're thinking, okay, I'm going to be maybe 10% or 12% or 15% in tax. We've done the math. I'm very, very fortunate to work in a group of very, very smart individuals in both the Ed Slott Master Elite Group. I also serve on Ed's board of advisors, and I'm part of David McKnight's, what does he call it? Mastermind group. So David he's got the Power Zero group, and I'm obviously part of the Power Zero Lead Advisor group, but I'm part of Dave's Mastermind group, I think is what he calls it. But just like with Ed, we help Dave make decisions about his organization. But we're convinced that by about 2030, and I'm going to show you why, your average middle-class American is going to be in about the 40 to 45% effective tax rate. So if you think you're rolling into retirement at 10 to 15%, and suddenly you end up there at 40 to 45%, that's probably going to have a significant effect on your retirement, your success of your retirement, and your comfort of retirement, because it's all about that spendable amount of money that we have. If you have $1 million in your IRA, you've got to ask yourself, how much of it is yours and how much of it is the IRS? It says, how much does the IRS own and how much do you own? Because it's not, that $1 million is not all yours. Right now, maybe $800,000 is yours and $200,000 is the IRS's, the federal government. The IRS just collects it. The government eats it. Well, what if we're at 40 and now it's 600,000 is yours and 400,000 has to go to the government? Folks, this is a real life scenario. And if you're fortunate enough to have more than $1 million, if you're $3 million or $5 million in your IRA, you're much more likely to plus this. Maybe you're at a 50% effective tax rate, because you got to start taking money out of your IRA at some point, and you're going to take it out for spending needs. Most people have most of their money in their traditional IRAs, traditional 401ks. That's where you've been spending because that's what you've been told. So if you need to take out $100,000 a year for expenditures, then that's going to be taxed, right? As soon as it leaves that IRA account or that 401k account, it's subject to tax. What's that tax rate going to be in the future? We know what it is today, but what's it going to be in the future? Even if it's not, what if I'm completely wrong? What if the folks who focus on this and study this and specialize in it are commonly asked by publications like Forbes, the Wall Street Journal, CNBC about our thoughts on this? What if we're completely wrong? And your brother, uncle, friend, whomever says, they don't understand it. They're wrong. You're gonna be in lower tax environment. Well, what if they're wrong and we're right? But what if we're wrong and you end up only at 30%? What if taxes for you only increase to 30% and you don't hit the 40 to 45%? And you need $100,000 a year. Well, you're netting out $70,000, right? When you were planning on maybe netting $80,000 at a 20% tax rate. And God forbid you were somehow thinking 10%. And you were looking forward to $90,000, and now suddenly you're at $70,000. Do you think that's going to change your comfort and your longevity of your retirement? I mean, your retirement's going to be where your retirement's going to be. You're going to be in retirement as long as you live, unless you got to go back to work, and that's not good. And it's more challenging as you get older, of course. But you're going to have these spending needs, and then even if you don't need the whole $100,000, the IRS is going to tell you exactly what amount you must need. Currently today, at age 73, it triggers your required minimum distribution. So you have a required beginning date. Andy, I've talked about that. It's April 1st of the year. Following the year, you turn 73 right now. And the IRS tells you exactly how much you have to take out of your IRAs and 401ks. And it's based on a table. Of course, you can find that table on attleborowealth.com. Go to the resources tab and to go to the slot corner, and it's all under there because these are Ed Slots tables. That orange table I just shared with you is an Ed Slot table. But at age 73, if you had $1 million, you'd have to take out about, I think it's $37,000. Now, you may not need that whole amount, but if you don't take it, you're subject to a 25% penalty, and that's actually been lowered. And if you take care of that in a timely manner, that can be reduced to a 10% penalty, but it's still a penalty nonetheless, and it stinks. So the IRS tells you exactly how much you have to take, and if you don't take it, you're penalized, and you must take it. You just have to take it. That is what causes tax in retirement. First of all, these myths and misconceptions. You haven't properly planned because you didn't know about it. You haven't properly planned by doing things like Roth conversions, things we're going to talk about in a minute, because you didn't know these critical items that could have a significant impact on your retirement. And if you would have known them at the time, you could have done things differently, or maybe you would have done things differently. But now you know because you're listening to this. And I'm telling you, you're likely to not only need more income than you're thinking during retirement. We talked about that in part 1. Go watch that. Medicare is going to cost more than you think. Go watch that in part 2. IRMA surcharges for Medicare are going to surprise you potentially if you're not planning for it, because they surprise everybody who's not planning for it. Watch that in part 3. And then your taxes are likely to be higher than you're expecting, and much, much higher. Some people legitimately think because they've been told they're going to be in a lower tax bracket, and we're today in some of the lowest taxes we've ever seen in history. Certainly during our lifetimes, they say, well, geez, if I'm paying 20% effective tax rate now, and all these, my 401k provider and my traditional financial advisor who hasn't really learned about tax efficient planning, and by the way, who's not allowed to talk about taxes, don't get me on that soapbox. These big firms, they have a big disclosure that says we do not give tax advice. Folks, taxes are going to be one of the largest expenses during your lifetime. Even if they stayed where they are today, it's going to be one of your largest expenses during your lifetime. The fact that these large firms just put out their hands and say, we're not going to talk about it, madness, complete madness. So, where was I? So if you think that if you're in the 15% or 20% effective rate and you think, well, I'm retired, everybody's telling me I'm going to be in a lower tax bracket, and you're thinking in your mind 10%, you're in for a world of hurt when you are just there in retirement. And if you don't plan for it, if you don't identify these critical items, and now that you know, make changes, you're going to be at a point when it's just too late to make changes, or it's going to be much harder to make changes. All right. So what are those tax risks? Some of these tax risks.